Welcome back. I'm Jay Fagan with the Maddox Group. Are you starting a business or are you running your business and your books just seem overwhelming? You don't know how to make sense of these numbers? Well, the best place to start is with a good, clean chart of accounts to direct your money into the correct buckets it needs to go and provide real-time, useful data so you can manage your business. We're going to walk you through a tax-optimized chart of accounts, talk through some of the things you need to do to keep your business operating successfully this year and beyond. So let's get stuck in. So what is the chart of accounts? In generally accepted accounting principles, these are the various buckets of money, income, expenses, assets, and liabilities that tell the story, the picture, present a picture at any given point in time of your financial records, your useful business financial information. And it's organized in a series of categories: assets, liabilities, equity, income, expenses, cost of sales, and other expenses and other income. Those are the broad spectrum categories. And there's a lot of subcategories depending on the type of business you're in that come into play and depending on the type of financial reporting you need to provide. Most small business taxpayers in the United States are going to operate under the cash-based system. And so the chart of accounts I'm going to show you is really optimized for that. However, there are certain accounts that are designed for accrual taxpayers, those who would report their expenses not necessarily when they pay them, but when they are deemed incurred or complete. The same thing with their revenue. Cash basis is we report revenue and expenses when we receive it or pay it. Accrual basis, we report it in the time in which it was incurred or relevant. So ultimately, there is a simple accounting equation. Assets equals liabilities plus equity. Your income and your expenses help determine your net profit or losses, which affects that asset and liability equation. Fairly simple, been around forever, it works. And if you've been around as long as I have, or many others in the industry, you remember when we used to do this by hand. Now we use computer systems, software, spreadsheets, etc. If you're looking to get started with your good bookkeeping system, there's a lot of options out there. We're an Intuit firm. We have been for years. It just works irrespective of how we all may feel about aspects of the software, the cost, etc. It's the 800-pound gorilla in the room. It just works. There are other options out there, and for certain businesses, they may be better. However, when you're getting started, a simple spreadsheet will do you. And this is why we prepared this download that you can get on our tax-optimized chart of accounts in Excel so that you can get started with this right away. So assets. These are your bank accounts, your cash on hand, your petty cash, the cash you have in your cash drawer. If you're in the accrual system, these are prepaid expenses. Maybe you pay for your insurance up front, like auto insurance, 6 months at a time. In particular, if you're a QuickBooks customer, there's an account called undeposited funds. It's a holding account. It's useful for the deposit process in QuickBooks. It doesn't exist in the regular accounting systems, but it is fairly common at the modern bank integrated general ledger systems. This is also where we consider your inventory. In some cash basis, small businesses don't maintain inventory. They just expense it when they purchase it, but others do in a hybrid system. So if you have inventory, you would report it on your balance sheet as an asset. Property, plant, and equipment. These are the fixed or high-cost items that you use to operate your business, such as business vehicles, furnishings, fixtures in your office or business space, machinery and equipment, buildings, if you're owning your building or you have leasehold or tenant improvements to a building that you're leasing. And of course, land. And remember, land is not deductible. Next, we have our liability. Generally, for most small businesses, these are your lines of credit, your credit cards, your accounts payable with your vendors. We'd also have here notes payable. So if you have a long-term or short-term business loan, or business line of credit, it would show up there. This is also a place where we see sales tax payable if you're in a business that charges sales tax. Sales tax is not an income item or an expense item. It is a holding account, a trust account between you and the tax agency. You're collecting that information on behalf of the tax agency from your customers and you're remitting it to them. And on the balance sheet is where we report that. Similarly, this is where we have payroll withholdings and payroll liabilities. So when you pay your payroll, even though you're a cash basis taxpayer, you have to collect certain monies from your employees, for example, their federal or state income tax withholding, and then you need to pay that to the IRS, or in the case of California, the Employment Development Department, on a periodic basis. And so on your balance sheet are those liability accounts, and that's where you would hold those monies until they are paid out. And again, and we look at the accounting equation, you're increasing the liability when you pay out your payroll to your payroll company, and you're decreasing that liability, and again, affecting cash whenever you pay out that liability to the tax agency. And so the equation stays balanced. Finally, on the balance sheet, we get to equity. This is for most small businesses where the payouts of the business's net profits flow to you. Ultimately, the income is taxable, but the payments of that taxable income to you are reported on the equity accounts. It's also where we have retained earnings. This is the account where the accumulated earnings and profits not yet distributed are placed for the taxpayer. And I want to talk about, for my small business owners, what is an equity transaction versus an expense? So the net profit of the business transfers out of the business to you. And if you're paying your quarterly estimated taxes the way you should, oftentimes we see these reported on our clients' books as an expense, and that is incorrect. That isn't a personal expense. And so the payment that you pull the cash out of the business, if you're partnership, sole proprietor, S corporation, you pull that distribution, you pull that income out of the business to make those estimated taxes. That is an equity transaction. It does not reduce your taxable income, but it is a legitimate transfer of profit, of cash, out of the business to you. And so that's where we're going to see it. Similar, we're going to see, if you're an S Corp shareholder, we're going to see the officers, the S Corp officer health insurance contributions, the S Corp officer's retirement contributions. Those are often equity transactions because they're reported on the personal tax return. The employer share of that transaction, of course, is a business expense for S corporations, but for sole proprietors and partnerships, generally that's going to be on the balance sheet. It's going to be an equity account. This is where we see a lot of gremlins with our small businesses on expenses versus equity. We see personal expenses get reported on the books because you had cash and you used the business cash to pay for it. I'm paying taxes on it. Why shouldn't I? Well, there be gremlins there. We want to keep our personal and our business fully separated. Separate business accounts. Don't get those personal expenses on the books. However, when you need cash out of your business to pay for your personal expenses, that is an owner's draw. That is an owner's equity transaction, and it's reported there on equity. Don't pay for that expense directly, but pull that money out of your business bank account into your personal accounts, report it on the balance sheet as an owner's draw. Totally legitimate, absolutely the correct way to go. Next, we're going to talk about income accounts. These are pretty straightforward. As you've heard in previous videos, all of the income your business receives is an income account, should be reported in an income account. Again, with the exception of those excise or sales taxes, those pass-through taxes. Now, for usefulness, we may break out that income into a variety of buckets: services, products, refunds or discount transactions with customers. We do that because ultimately your books are not really about your income taxes. Your books are a reflection of your business's information. It's helping to categorize and visualize what your business did at any given point in time. Bookkeeping is about good business first. First, foremost, period, full stop. It's about good business. Good books, good business. A beautiful side effect, or gravy on the biscuit, as I like to say, is it helps make the tax season absolutely seamless. So we generally have a lot of expense items and income items broken out into categories because we want to have useful information for the business, even if for tax purposes they just kind of roll up into one bucket like income. When it comes to expenses in particular, this is where we see a lot more customization. And in our sample chart of accounts, we're tying these expenses directly to the usual and customary buckets that you see, line items you see on the respective tax forms. Not all businesses need these accounts, and many businesses need far more level of detail in these accounts. Again, good business decisions, good business information should drive that decision. But in general, occupancy expenses, these are the expenses around running the physical plant of your business, the office or the warehouse or the factory. Okay, so your rent, your utilities, telecommunications. If you have a loan on your building because you own your building, this would be where the interest would go for occupancy related mortgages. You're going to wind up reporting that for tax purposes on just business interest. However, on your chart of accounts, it's very helpful to have it here because, again, it's helping to drive business decisions and give you information about how your business actually works. We then break it down. We have insurance expense. This is business-related insurance, generally liability or workers' compensation, business insurance. Marketing expenses. These days, there's all kinds of marketing expenses from Facebook ads, Google ads, listing fees, website domain listings, etc. Those are great expenses to report under marketing. We used to call this G&A, general administrative. General administrative and office expense is what we have here. This is where, now bad debt, I'll note when you look at this, is really only for accrual-based taxpayers. Cash-based taxpayers do not have bad debt expense. They just don't report the income because they didn't receive it. But your dues and your subscriptions, your office supplies, your software subscriptions, things like that, small tools and equipment, these are all going to be reported under general and administrative expenses. Personnel expense, very, very useful account here when you have employees. And again, a little bit of note, officers of S Corps are pulled out separately. Partnerships and sole proprietors don't have wages for their owners. They don't draw a wage, they just take distributions. S corporations, of course, do have a reasonable compensation. We have a video talking about that linked here. However, if you provide guaranteed payments to partners for services, if you're a partnership, this would be an area to report that because it does reduce the taxable income of the business. Payroll service fees, which could also fall under accounting expense. These are things like your payroll service provider, your 401k provider, and employee benefits. Again, we want to break out owner benefits from employee benefits depending on your tax situation. Then we get into professional fees. These are generally, for most small businesses, they're legal and accounting fees, but this can also be a variety of consultants and contractors, information technology services. This is also a great place to put training expenses, conferences and conventions that you attend. Great catch-all category for services, outside services that you incur for your business. Then have meals and travels expense. This is again an area where we have some gremlins. Remember, personal travel, never a business expense. However, there could be a portion of the travel that does have a business purpose if it's related to official business travel. So make sure you separate that cleanly. You pay for that separately from your business account to your personal account. Only report the business side on your books. This is also where we usually see parking and tolls expense. Fees and interest, bank fees, credit card fees, mortgage interest, finance charges, merchant service fees can all fall under here. We do often in with our retail clients, we do often put the merchant service fee as a cost of sales as it's directly related to the cost of doing business. We'll talk about that shortly. And then we get into automobile and vehicle expenses. Not every business has these, and oftentimes businesses pay for these when they're really a personal expense. And we've got a video on meals and travel, as well as a video on automobile and personal versus business expenses around your personal vehicles, your business vehicles coming up. So stay tuned for those. Now we get into cost of sales. Now, before I say that, again, this is a general broad spectrum of categories that's fairly consistently reported on all of the books across all tax forms. You may need some customization that exceeds this. You may not need all of these accounts based on your business. Cost of goods sold, cost of sales. Now, in our numbering scheme, you'll see this here that it starts with a 6, and we use a fairly traditional numbering scheme. We still believe in account numbers for your chart of accounts because it does make it easy in an accounting system to just type in a few numbers that you've memorized, that you use frequently. So we use 1 for assets, 2 for liabilities, 3 for equity, 4 for income, 5 for expenses. In a traditional kind of broad spectrum GAAP compliant, generally 5 would be cost of sales. However, not a lot of businesses have cost of sales accounts. We tend to find that most business owners are working predominantly in their income and expenses, 4 and 5. So we keep those together, and we change cost of sales to 6 because we want it to trigger in your mind that it's out of the ordinary. It's not a usual and customary expense. Think 6 when it's cost of sales, taking you a little bit out of the norm. Cost of sales, cost of goods sold. These are expenses you incur directly as a result of the sale. They are not general administrative. They're not variable. They are really specifically tied to the sale. Often we see this as cost of labor or subcontractors in the construction industry. We see this in materials and supplies directly related to the sale. We see this, as I said, in merchant service fees on every transaction that you incur, credit card sales type of situation. Then, of course, we move to 7, which is other income accounts. And again, we want to pull you out of the norm. We want you to be thinking that this is a little different. Instead of 4 and 5, it's 6, 7. If you haven't gathered, I've got small children. So here we have other unrelated business income. We have things that are outside of your normal income. Often this is interest income, the most commonly reported, or miscellaneous reimbursements or fee income that you don't ordinarily receive in your trade or business. We often see credit card rewards reported here, and credit card rewards by and large aren't taxable income. However, if you apply them against your credit card balance, against expenses that you've incurred, well, those expenses aren't deductible either. So for just simplicity's sake, we generally see credit card rewards reported under other income, and the credit that you apply to your business account just treated that way as a cash transaction, and the expenses not reduced. It does simplify the overall transaction. Again, it's a wash in the end. And lastly, here we have 8 and 9. Other expenses, category 8. This would be depreciation and amortization. It's a below the line expense for accounting purposes. And again, it pulls it out. And then an account we love to use with our clients. We recommend that all folks have it as a expense account or an Ask My Accountant account if you're in QuickBooks Online. Essentially, you don't know what this transaction, what bucket it should go in. So you plug it there so you can reconcile your bank accounts. You can keep the business moving forward until you have time to speak with your trusted advisor and make the right call. And lastly, we pull out business taxes into accounts starting with 9,000 accounts, because business taxes, depending on the business, may be an expense, depending on the tax, the nature of the tax, state business taxes, or it may be an equity account. And so oftentimes, because it's a personal expense of the taxpayer, it needs to be reported there. And oftentimes the taxpayer isn't aware or isn't familiar. And so we can throw those accounts in other expense, tax expense, keep those transactions there until they can be reconciled and reviewed with your accountant, and develop a system and a process that you know, you trust, and you can understand and execute moving forward. So this is a broad spectrum of the basic chart of accounts. And again, we've paired it with the relative form line numbers that on your tax return. So if you're self-filing, you have some useful information here. If you're conversing with your tax advisor, you're not one of our clients, and you want to understand the impact it has, that will give you a point of reference. You'll note there's a couple of accounts where these have multiple line items listed for the particular chart of account. That's because they could kind of go in either bucket. They might be reported some in one bucket, some in the other, and there may be some disagreement between different tax advisors as to which one they use when they're preparing their clients' tax returns. Ultimately, though, you want your chart of accounts to inform your business decisions, to help tie to your tax returns, and provide you information that you can understand and make good decisions about. Thank you so much for paying attention and investing your time with me. If you have any more questions about this or any other aspect of your business, don't hesitate to reach out. I'm Jay Fagan with the Maddox Group. It has been my absolute pleasure. Stay tuned for additional videos. Allons-y.